Hello, everyone. 3 stocks, big stocks, just reported after hours. The first one is Costco. The other 2, just listen to the video. I will explain them more. But really quick, if you're new to the channel and some of these things sound a little hard to understand, just be patient. We have over 1,900 videos. Just take some time, watch 4 or 5 videos. I guarantee you'll walk away understanding investing a little bit better. And if you need to rewind some things and listen to them, hopefully it makes more sense the second and third time around. So Costco did miss. They reported $3.07 per share versus expected of $3.14, and their revenue came in at $53.44 billion, missing $54.81. Now, my guess would be inflation related.
Yeah, probably.
People felt the pinch elsewhere. They probably had to pull back a little bit.
Yeah, Costco had a massive run up. I mean, that was the place to go during the pandemic. Bulk shopping, more savings.
I mean, look at that stock.
I know. Look at that is a heck of a run. I mean, even let's just draw it from here.
Do the 5-year chart, Mo. Just
5-year chart?
Do the 5-year chart over there. I mean, it's just straight up line.
It is. It's crazy.
Now, Charlie Munger.
It's actually consolidated a lot in 2022.
Oh.
Yeah. It hasn't actually gone up or down.
I think it hit 600 at one point, though, didn't it?
All-time high was 6/12/27.
What date?
That was 4/6/22. So
all right, early this year.
Yep.
So guys, Charlie Munger loves this company, and his reason is that nobody does more for the customer than Costco does. Now,
yeah, he says they have a good ethos.
Now, I don't even, good for him. Now, remember, a great company is different than a great stock.
Yep.
So you have to separate the two. If you're new to the channel, hear that again. Great company does not mean great stock. You can have a great company and the stock be massively overpriced and be a bad investment. That is something very important to understand in value investing. A couple of things on Costco I want to show you that it might blow your mind a little bit. First off, look at their profit margin. 5-year average of 2.4%. Profit margin last year, 2.6%. Now, here's something I guarantee that our friend Charlie Munger and Warren Buffett love.
Yep.
That return on invested capital of 17.4%.
That's big.
They believe, rightly so, this number, what it says is they do a great job of getting a return on the money invested in the business. And if their weighted average cost of capital, that's the return they need to give to the people who lend them money and the people who own the company, that return is probably somewhere in the 7 or 8% range right now. Maybe it's 6, maybe it's 9. The bottom line is this is a huge number. This means they're making real economic profit for their investors. And Munger has said that even if you overpay for a company, if it has a high return on invested capital, you'll probably do well. But time out, that doesn't mean pay whatever price.
Correct.
Because guess what? The company's turned $13 billion. Fine. Pay $2 trillion for it. Does that mean you're going to get a 17% return? No. And that's the key here. So let's look at the 8 pillars on this company. I can't believe they're only down. Oh, now they're down 1.7%.
Yeah, 1.7%. I saw it a little over 2% just a few minutes ago.
Oh, you did?
Yeah.
Well, maybe now they're probably having a phone call, yep, or they're releasing more information. And a lot of times guidance can make the stock go up or down at any given time.
So I didn't see any guidance in their press release. So people are probably waiting to hear guidance on the call.
Oh, okay. Got it. Yep. And by the way, if guidance is good, that might make the stock skyrocket. If guidance is bad, it could plummet.
Right.
We don't know. Our goal, we only look at these attributes of the company on a short term just to take advantage of big drops in the stock price.
Yeah, exactly. There's no point of us looking and saying, hey, this is a really great quarter. We're going to go and buy them. This is
Correct.
a really bad quarter. Oh, I'm out on Costco.
Listen, they made $3.07 versus $3.14 estimated. What did they make last year, same quarter? Let's look.
Question.
Because is it still growth? Let's find out here. So let's do the per share quarterly data. So last year would have been, which quarter would that have been? The 11th one?
Yep.
They made $2.99. Okay. So they made more money, yeah. 2%, 3% more money.
Yeah. And I see here, net sales for the first quarter increased 8.1%, to $53.44 billion from $49.42 last year.
Can you do me a favor?
Sure.
What am I going to ask for?
Same store sales.
Same store sales. Guys, when it comes to retail, you got to look at same store sales. These are stores that typically have been opened over 12 months. It allows you to see how the company organically is doing, because it's easy to grow revenue by opening more and more stores.
Yeah.
But if your existing stores aren't growing, then you're just expanding into a declining business, which is not a good use of capital. All right. So while he does that, this is the 8 pillars. They've issued a few extra shares. I'm not worried about that. 1.4% over 5 years. Yeah, whatever. But here's the big numbers. Guys, they're selling for 50 times their 5-year profit and 5-year average free cash flow. How can they possibly grow into that number? I immediately know that's going to be, it's just, unless they had 30, 40, I mean, what growth level do you need to have to justify these kind of numbers? Can they grow their profit high? Sure they can. They have a really high return on invested capital. But at what point is that just too much? Because if you think this is okay, then why not 60 times? Why not 70 times? Why not 80 times? At some point, it's just too much. Now,
wow.
What's the issue?
14%.
Same store sales growth?
Net sales, this was highlights for 2022 versus 2021. Net sales increased 16% to the number, driven by 14% increased comparable store sales and sales at new warehouses opening locations.
So you know what happened here? They had high costs. They probably absorbed a lot of the costs of increases. Go ahead.
Could that number be high and affected because of going back from COVID?
No.
Okay.
Oh,
because you'd have a big decrease and then a big influx.
To me,
but
the reason
the
reason would be inflation probably. It's a tough one. I don't know.
Yeah.
We'll see what they say in the call.
Either way, I'm sure it was somewhere around 4. It's probably really.
Man, that's a big number.
It's a big number.
14%.
Let's put it this way: it's not going to be. Let's say that what I said was correct. It's not going to be 1%. You know, they did something really well.
All right. So EPS estimates by our analysts. They're expected to make. They made $13.39 last year and $22.72. So decent growth here, about 10% a year. Nothing to write home about, but nothing bad. Revenue growth, not that much. 230 to 295. It's what, mid-single digits. All right, nothing great. Let's go to Stock Analyzer tool and see what we think it's worth. Let's do a 10-year analysis.
Okay.
Mo, you do your number. I'll do mine.
Okay.
Wow, 14% same-store sales growth?
Yeah.
Crust.
I'm going to do this.
Why are you laughing, Sam? Because I said crust? All right, so.
You know what? I am actually going to put in the same number across the board here.
Wow, look at you, big shot.
Because it's just so dang consistent.
All right, so I put some numbers in. I'm going to wait for Mo's numbers because I want to hear what Princess over there has to say.
Okay, ready?
All right, Mo, what are your first numbers?
1, 5, and 7.
Ready for what I did?
Oh my God.
You know why? I wanted to go crazy.
Okay.
Because we had a 16% number and then 14% same store. Let's say we have inflation that's crazy for the next 10 years.
Okay.
All right, I went 3, 8, 13.
Okay.
Well, that just melted Mo's mind. I do think 1 is way too low.
I think 1 is way too low, and
it's absurdly low.
I thought 5 and 7 were pretty good numbers.
I agree with you.
Yeah.
Like, I do think it's going to be somewhere in between there.
So it's funny. And here's the great thing about Stock Analyzer tool. You can put in super low numbers or super high numbers because I usually look at one of the categories and I'm like, yeah, I don't agree with that one.
Correct.
So the 1 is where I don't agree.
I don't think 13% is going to happen, but the reason I put 13 in is I want to show you how expensive the stock is.
Okay.
Margin.
I did 2.5 across the board.
You know, I think that's a good idea. I did 2.2, 2.4, and 2.6. 2.5 across the board is probably a good idea because it's going to be effing close to that.
Yeah, and I did the same thing for free cash flow margin.
Fair enough.
14,
PE.
16, and 18.
I did 15, 17, 19 because of the high return on invested capital for both PE and price of free cash flow. Return.
And return 12, 14, 16.
We agree on one of them, on one of the lines. Guys, the point of this is just look. We're two value investors. We're great friends, even though we just had a screaming match with each other. We love each other, and guess what? We come up with different numbers. That's the art of investing. It's going to be your inputs, and you have to sit there and make some sort of gauge of the value there. Hit the analyze button. Right. Ready for this?
476 is the price.
150 low side, 310 high side, 215 middle. So to be honest with you guys, my thought is 200 to 250. So I should probably change my watch list to a lot lower. What's yours, Mo?
My watch is at 225, but 139 to call it 187. Middle ground 175.
So guys, the whole point I'm trying to make is 13% revenue growth for 10 years and it still only justifies 309. This is just math.
That's the crazy part.
That's the hard. This is an overpriced stock. Yep. And you know what? I know Charlie doesn't sell it, but that's because he's being smart of saying, listen, I'm not here to time getting in and out of the stock. It's a good stock for me. I'm going to keep it. Yep. Next company, Lululemon. beat on revenue and profit, and they have plummeted.
Yikes. Down 9%. They were down as much as 11% at one point.
Wow.
Yeah.
So my guess is they're guiding something poorly because they reported $2 per EPS versus $1.96 and $1.9 billion in revenue versus 1.81. How do you do that? And by the way, we did a Lululemon video. It's coming out when?
Tim, do you know when that's coming out? Soon, probably next week.
So
Monday.
So subscribe to the channel. You'll find it on Monday, the Lululemon video.
Quite shocking of what we found in there in the 10K.
Really? Yeah. Oh yeah, what you and I found.
Yeah,
I thought it was like you and Nicole. I'm like, what were you guys doing?
Oh, no. There's nothing new to find in Lululemon stores.
Company number 3, Docusign.
Docusign, yep.
57 cents reported versus 42 cents estimate, and $645 million in revenue versus 627, and they are up
16.25% right now. Yeah. They must have guided.
What's their all-time high?
Their all-time high is
313.
313, and that was in September of 2021.
Interesting.
And their low is $39.57
in the last 1 year.
Yeah. And it was almost there recently.
Yeah.
As of today's close.
So guys, this just goes to show that just take out the noise.
Yeah.
These companies all made money, but maybe they didn't make as much as they're supposed to, but they all made money. That's the point of being a long-term value investor. Your goal is to take the market's reactions to these ridiculous small changes, and when they beat the company up, you sit there and say, the 3 questions I love to ask: is the company going to be around in the next 10 years? If the answer is yes, my next question: do I think the revenue and profit will be higher 10 years from now than today? If the answer to that question is yes, I go to my 3rd question. And the most important one, and the one that gets answered no the most: can I pay a reasonable price for the company today, factoring those 2 things in? So guys, subscribe to the channel. If you like our software, we have a risk-free guarantee. If you sign up for the software in less than 30 days, if you don't like it, email us, 100% of your money back. Thank you very much for your time.